Okay, so you want to own a medieval monastery. You picture the cloister at dawn, monks in silence, candlelight on a manuscript, bells over frozen fields. A place deliberately set apart from money, from ambition, from the world. The one institution in the Middle Ages that wasn't trying to get rich. One number ruins the picture. Around 1320, a Florentine banker named Francesco Balducci Pegolotti spent 3 years in England working for the Bardi Company, and he compiled a book. In it, he listed English monasteries by name, with the number of sacks of wool each one produced every year, and the price he expected to pay for each grade. It is a supplier catalog, and when historians check one of the houses on his list, Buildwas Abbey in Shropshire, 20 sacks a year, the wool alone was worth more than the estimated annual value of every other thing the abbey owned, put together. Read that again. The land, the mills, the rents, the tithes, all of it were worth less than the sheep. The prayer was never the business. The wool was, and the thing that made all of it possible wasn't holiness. It was a legal trick so powerful that we still use it today, and we still call it by the same idea, a body that never dies. Nobody teaches you this. You can go through 12 years of school and never learn that the richest institutions in medieval Europe were, functionally, corporations, that they invented perpetual ownership, sold retirement annuities, and traded commodity derivatives 400 years before anyone drew a stock exchange. So let's build one from scratch, using the actual surviving contracts and the actual government valuations, and follow every penny from the founder's deathbed to the king's treasury. Because by the end, you'll see that a monastery was never really a house of God. It was the first immortal company, and you'll make 3 decisions that decide whether yours becomes one of the richest institutions in England, or is dispersed into debt and forgotten. Let's start with money, and to do that you need one conversion in your head for the whole episode. An ordinary laborer in England around 1300 earned about 2 pence a day, roughly £2 a year. That's your anchor. A pound is 240 pence. So 1 pound equals about 120 days of a working man's life. Now hold that against the top of the market. In 1535, when the crown finally counted, Glastonbury Abbey was valued at over £3,000 a year. £3,000. At 120 laborer days to the pound. That is 360,000 days of human labor. Roughly 1,500 years of a working man's life, flowing in, every single year. A wealthy baron might have £600. Glastonbury had 5 times that, and unlike the baron, it was never going to die. And that gap is not an accident. It is the entire design. So, what does it cost to open one? Here is the first strange thing about this business, and it inverts everything you expect. You don't buy a monastery. Somebody gives you one. A lord, a king, a wealthy widow founds it. They hand over land, sometimes an enormous amount of land, and pay for the building. And they do this for a reason that is perfectly rational once you understand what's being sold. They are buying prayer. Specifically, perpetual intercession, masses said for their soul, and their families' souls, forever, by men whose entire professional life is prayer. Think about what kind of contract that is. The customer pays the entire sum up front, in land, and the service is delivered continuously, for eternity, long after the customer is dead. It is the world's first prepaid perpetual subscription, and the founder can never cancel it, complain about it, or ask for a refund, because he is in the ground. So your cost of entry is 0. Your startup capital is somebody else's fear of hell. That sounds like a joke. It is the single most important fact in medieval economics, because of what happens next. Now, the ruling number of this entire business. It isn't the price of wool, and it isn't the value of the land. It's perpetual succession. A monastery is a corporate body. It doesn't die. And that one property changes everything. Because look at how every other landowner in England loses land. A baron dies. His estate is split among heirs. Or a daughter marries it into another family. Or the crown takes its feudal dues on the transfer. Or a spendthrift grandson gambles it away. Ordinary wealth leaks, constantly, through death and inheritance and stupidity. A monastery has no heirs, no marriages, no death duties. Monks arrive, take vows, and die, and the institution doesn't even blink. It simply recruits another. Every acre that goes in never comes out. That is a one-way ratchet. And run it for 400 years, and you get Glastonbury. If that sounds familiar, it should. We reinvented this and called it the corporation, a legal person that outlives every human being inside it, that can own property in its own name and hold it forever. The monasteries got there first, by centuries, and the medieval English state understood exactly how dangerous it was, which is why in 1279, Edward I passed the Statute of Mortmain. Mortmain, dead hand. Land that passed into the church's hands was said to fall into the dead hand, because the hand never opens again. After the statute, you needed a royal license to give land to the church at all. The crown didn't ban gifts to God because it was impious. It banned them because it was watching its tax base disappear into an institution that would never die and never pay a death duty again. So you have free capital and a legal structure that never lets go of it. Now you have to actually make it earn. Let's walk the revenue. Layer 1. Land rents. Your manors are worked by tenants who owe you money, produce, and labor. This is the broad, stable base of monastic income, and in the Valor Ecclesiasticus, it's the biggest line for most houses. Rents, demesnes farms, and customary payments from tenants. Layer 2. Tithes. You hold the right to a share of the produce of parishes, income that arrives without your doing anything. Layer 3. Monopolies. The mill the tenants are legally required to grind at, the market, the fair, rights of way and tolls, every one of them a small compulsory recurring payment. Layer 4. The relic business. And we should be honest about this one, because the record is not subtle. Glastonbury's church burned in 1184, and the monks needed an enormous sum to rebuild. In 1191, 7 years later, they announced they had discovered, on their own grounds, the grave of King Arthur. They also, over time, turned up St. Patrick, St. Brigid, St. Gildas, St. Indracht, and St. Dunstan, the last of whom is particularly awkward, because Dunstan had indisputably died as Archbishop of Canterbury and was buried at Canterbury. Now, you can believe whatever you like about medieval relics. But look at it as an owner. A relic is a permanent destination asset. It brings pilgrims. Pilgrims need beds, food, candles, and badges, and every one of those is sold by you, in a town you own, on a road you control. Glastonbury did not find King Arthur while it was comfortable. It found King Arthur while it was rebuilding. Layer 5. The Corrodi. This is my favorite, because it's the one nobody expects. A monastery would take a lump sum, cash or land, from a layman, and in exchange give him board, lodging, food, and fuel inside the precinct for the rest of his life. A medieval retirement home, bought with a single payment. That is an annuity. You are underwriting longevity risk. If your customer dies in 3 years, it's the best deal you ever made. If he lives 25, you are feeding a healthy old man for a quarter of a century out of money you spent long ago. Monasteries sold these, and monasteries got badly burned by these, for exactly the same reason pension funds do today. And layer 6, the one that made the great houses great. Wool. England produced the best wool in Europe, and the cloth industries of Flanders and Italy were desperate for it. The Cistercians in particular ran enormous sheep operations on land nobody else wanted, moorland, waste, upland, and turned grass into an export commodity. In Pegolotti's list of wool-producing monasteries, around 85% of the houses are Cistercian, and it was graded like a modern commodity. Pegolotti didn't just write down a house and a number. He priced the clip in 3 tiers. For Buildwas, he recorded 20 marks a sack for the best fleeces, 12 for the middle quality, and 10 for the broken wool. And a mark was 13 shillings and 4pence, 2/3 of a pound. So the spread between your best wool and your worst was double, which means your abbey was being paid not for how much wool it produced, but for how carefully it was sorted, packed, and graded before it left your gate. There were quality standards, an accepted grading vocabulary, and a foreign buyer's price list you could be measured against. In the 1300s. That's the business. Not prayer. Prayer is the founding story and the daily work. Wool is the cash. Which brings you to your first real decision as the man running this house. And it is the most modern financial decision in the entire Middle Ages. Your abbey needs money now. Maybe you're rebuilding the church. Maybe you're buying up neighboring manors. Your wool clip comes in once a year, and the price swings. So an Italian merchant makes you an offer. He will pay you a large sum in cash, today, in exchange for your wool, delivered to him, at a price fixed now, every year for the next 5, 10, sometimes 20 years. Take a moment with what that actually is. Cash up front, against a commodity that does not exist yet, at a price agreed today, with penalty clauses for failure to deliver. That is a forward contract. More than 200 of these agreements survive in English government records, most of them between monasteries and Italian merchant houses, and modern finance academics have gone back and studied them. There is a paper in the Journal of Banking and Finance analyzing the interest rates implied in medieval wool forward contracts and asking how efficiently they were priced. Cistercian monks were writing derivatives in the 13th century, and both sides had good reasons. You get certainty and cash now, and protection against the spot market collapsing. The merchant locks in a guaranteed supply of high-quality wool at a known price, and, this is the part he cares about most, he locks his competitors out of it. So do you sign the forward contract and build now, or do you sell year by year at whatever the market gives you, and build slowly? Hold your answer, because there's a real abbey that answered it. Now, staff the house, because the org chart of a monastery tells you what it really was. At the top, the abbot. And the abbot is not primarily a spiritual figure. He is a chief executive with a seat in national politics. Below him, the prior runs the internal life. But the officers who matter to the balance sheet are the obedientiaries, and each one runs a department with its own income and its own accounts. The cellarer handles supply and provisioning. The sacrist maintains the church and often controls the offerings. The almoner runs the charity. The bursar handles cash. Separate departments, separate revenue streams, separate books, reporting up to a chief executive who answers to a board, in this case an order, and ultimately Rome. That is a corporate structure. It has a name, and a hierarchy and internal accounts. And it existed because these institutions were far too large and too complex to be run out of one man's head. And notice who is missing from that chart. Shareholders. There are none. Nobody can extract a dividend, because nobody owns it. The institution owns itself, which means every penny of surplus has only one place to go, back into the institution. More land, more sheep, more building. An entity that cannot pay out, cannot die, and cannot stop accumulating. 400 years of that, and you don't need a conspiracy to explain monastic wealth. You just need compound interest with no exit. Now the trapdoors. And there are two, and the first one is the forward contract you were just offered. Here's what happened to the Abbey of Pipewell, in Northamptonshire, and I want to be precise because this is documented in detail. Pipewell was a Cistercian house. In the 1270s, it needed money to complete its building program, and it entered into advance contracts, selling future wool for ready cash. Its creditors were a firm of Cahorsan merchants. At the time, this looked innocent and sensible, and everyone was doing it. Then, around 1300, sheep disease swept through English flocks. Look at what that does to a forward contract. Your obligation is fixed. A set number of sacks of a set quality, at a set price, on a set date. But your production has just collapsed. You cannot deliver. And when you cannot deliver, you don't simply lose a sale. You are in default, with penalty clauses, to a foreign merchant house with access to the royal courts. So you buy wool from other producers, at market prices, to fulfill a contract priced years ago. Or you borrow against next year's clip to settle this year's failure. Or you renegotiate under royal pressure and end up owing more. One historian described what followed as the fires of indebtedness which gutted English Cistercian houses at the end of the 13th century. Add royal taxes, wars disrupting the export routes, and long, expensive lawsuits. And the machine that made these houses rich ran violently in reverse. Pipewell spent the next 50 years sliding into penury and was dispersed. And it wasn't only Pipewell. When Bailen lost its flocks in 1281 and 1282, it had to petition the king to persuade the Italians to reduce its debt. Think about what that means. The most legally immortal institution in England, holding land it could never lose, was brought down by a promise to deliver something it hadn't grown yet. Perpetual succession protects you from death. It does not protect you from a contract. Which brings us to the second decision, and the wisest abbots faced it constantly. How much of the future do you sell? Forward contracts fund the cathedral you want to build in your lifetime. They also mean that a single bad decade, one disease, one war, one collapse in the price of wool, arrives as a legal obligation rather than a bad year. Do you finance growth on the future clip, or do you accept that you'll never see the church finished? Now the second trapdoor, which is the one that actually ended this business. And the striking thing is how much warning there was. Because Henry VIII was not the first king to rob the monks. When Richard I's ransom had to be raised in the 1190s, the crown took the Cistercians' wool clip. That is the pattern. Centuries early, an institution with enormous visible wealth, no army, and no heirs, sitting inside a kingdom whose king periodically needs money badly. You are the richest thing in England that cannot fight back. And in January 1535, Thomas Cromwell's commissioners come through the gate. The stated purpose is tax. Henry has broken with Rome, made himself supreme head of the church, and decided the taxes that used to flow to the Pope will now flow to him, plus a new 10% annual charge on the income of all church lands and offices. To levy that, he needs to know what everything is worth. So the commissioners sit down with the heads of every monastery, college, and hospital in England and Wales, and they take sworn testimony. Your income, your lands, your revenues from every other source. The result is the Valor Ecclesiasticus of 1535, and it is one of the most remarkable economic documents in English history, a complete financial survey of an entire sector, taken from the sector's own mouth under oath. It found roughly £200,000 a year in church income, of which the religious houses accounted for well over 140,000. The Benedictines alone, some 213 houses, accounted for around £70,000, close to half of all monastic income in the country. But the survey also caught the other end of the market, and this is the part that gets forgotten. For every Glastonbury there were dozens of small houses barely holding on. Rusper Priory in Sussex had been worth over £40 back in 1291. After the Black Death it never recovered. 8 nuns in 1442, 5 by 1478, 3 by 1527. The Valor put it at £39 a year. When the commissioners finally closed it in 1537, there were 2 women left in the building, the prioress and 1 sister, both described as very aged, with 2 servants. £39. Glastonbury was on 3,000. These were not the same business, and they were about to be treated as though the only thing that mattered about them was which side of a line they fell on. So here is your third decision, and it is the cruelest in this whole series, because it looks like paperwork. The commissioner is sitting in front of you with a pen. Do you declare your income honestly, or do you understate it? Declare honestly, and you are a loyal subject, correctly assessed, paying the king his 10th. Understate, and you're committing fraud against a monarch who has just executed men for less, but you look poorer, and perhaps less worth taking. Answer before you hear what happened, because in 1536, the very next year, Parliament passed an act dissolving every monastery with a declared income of less than £200 a year, about 300 houses, gone. The survey they had sworn to as a tax assessment had become the criterion for which of them would be destroyed. Their own honest paperwork was the map. And if you're now thinking that the smart play was to overstate your income and stay above the line, in 1539, Parliament passed another act closing all of them, regardless of size. The great houses that had cleared the £200 threshold were pressured into surrendering. Glastonbury, £3,000 a year, the richest of the rich, was suppressed in November 1539, and its abbot was executed. By 1540, more than 800 religious houses were gone, and the largest transfer of land in English history since the Norman conquest was complete. There was no right answer to the commissioner's question. That is the point. When your survival depends on a number reported to the man who wants your assets, you were never really the owner. Now run the 2 centuries every house lived, the version that works. You're a Cistercian abbey on land nobody else wanted. Your founder's grant cost you nothing. Your flock grows. Your wool is graded well enough that a Florentine agent writes your name in his book. Your rents come in. Your mill grinds by law. Your relic draws pilgrims to a town you own. You sell no more of the future than you can safely deliver. And because nothing can be paid out and nothing can be inherited away, every good year compounds into the next. 200 years of that, and you are worth more than an earl. You own manors in 6 counties, and your abbot sits in Parliament. The version that doesn't. You are Pipewell. You take the cash to finish the church, because the church is what you're for. The contract is signed, the masons are paid, the building goes up. Then the sheep die. The obligation doesn't. You buy wool to cover, you borrow to buy, the king's taxes rise, war closes the ports, and the lawsuits start. 50 years later, the abbey is in penury, and the community disperses, and the land, the one thing that was never supposed to leave the dead hand, leaves. And then, for everyone still standing in 1535, good managers and bad, rich and poor, honest and otherwise, a survey, an act of Parliament, and 4 years. So here is the whole business, in 4 numbers. Cost to open the doors, nothing. Someone else founds you and endows you with land, buying perpetual prayer for their soul. Your startup capital is a stranger's fear of death, the number that rules it, perpetual succession. No heirs, no marriages, no death duties, no dividends. Every acre that enters never leaves. Compound accumulation with no exit. which is why Edward I tried to stop it in 1279 by law, and why Glastonbury ended up on £3,000 a year, 1,500 years of a labourer's wages, annually. Where the money actually is, not the altar. Wool. At Buildwas, the clip was worth more than everything else the abbey owned combined, and the fastest way to lose it all was to sell that wool before it existed. Survival odds, irrelevant to how well you run it. 800 houses, some 4 centuries old, were closed in 4 years by a king who first asked them, politely and under oath, to write down exactly what they were worth. So if you do take the abbot's chair, understand what you actually hold. You don't own a monastery. Nobody does. That's the trick that made it rich. You are the temporary manager of an immortal company that owns itself, financed by the dead, invested in sheep, and protected by a legal fiction that works perfectly against time, inheritance, and misfortune, and not at all against a mortal king who can simply pass a law. Get it right, and your accounts are still being read by economic historians 500 years later. Get it wrong, and you're a ruin in a field with a very good story about King Arthur. And if the idea that the real invention here was the immortal owner, not the prayer, not even the wool, just landed for you, then you already understand the thread this whole channel pulls. The same idea explains businesses 400 years apart. Subscribe, and you'll get the next one.